You pull up to your parents' brick veneer home in the outer suburbs. The driveway is full. You parallel park your 2008 Toyota Corolla on the nature strip, the front left tire resting in the dry grass. The silver paint on the roof is peeling in a map-like pattern of sun damage. You pull the handbrake up 3 clicks until it catches. You turn the key backwards, and the engine shudders before dying into absolute silence. Walking up the driveway, you pass your older brother's brand new Audi Q5. It is metallic charcoal, gleaming under the street lamp. The yellow dealership plate still bolted tight. The pristine alloy wheels are larger than your steering wheel. Walking past the heavy door, it smells of synthetic leather and undeniable financial success. You walk through the front screen door, the aluminum frame slapping shut behind you. Your brother casually tosses his heavy Audi fob onto the kitchen bench next to the Christmas pavlova. It lands with a solid plastic clack that makes everyone look. You slide your plain metal car key deep into your pocket so it does not scratch your phone screen. You grab a glass of tap water and lean quietly against the kitchen counter. Your aunt asks your brother how the corporate promotion is going. He smiles, nodding and gesturing vaguely toward the vehicle parked outside. You sip your water in silence. You pull out your phone and check your banking app, staring at the modest balance, just letting the screen dim slowly until it turns completely black. There is an entire financial architecture designed to punish your patience and reward the immediate performance of wealth. The system absolutely does not want you driving that fading silver Corolla. A major Australian bank like the Commonwealth Bank or Westpac will happily approve a $90,000 personal loan at 8.99% interest in 45 minutes on their app, but they will ruthlessly scrutinize your Woolworths grocery transactions if you ask for a mortgage. The car dealerships partner directly with lenders to build complex novated leases that wrap the vehicle, insurance, and running costs into one neat, pre-tax deduction, masking the brutal reality of depreciation. The Human Resources Department facilitates this transaction, showing you how the lease payment drops your reported income just enough to avoid the crushing blow of the Medicare levy surcharge. They sell the lease as a brilliant tax hack, convincing a generation of mid-level managers that spending $100,000 on a depreciating piece of metal just to save $12,000 in tax is a financial masterstroke. The finance desk is not selling a motor vehicle. They are selling a highly engineered consumer debt product designed to trap your future income into monthly direct debits long before that money hits a savings account. Year 1, the purchase. You sit at your particle board desk looking closely at a budget spreadsheet. You earn $85,000 a year. Your brother earns $95,000 a year. The difference in your take-home pay is practically nothing after the Australian Taxation Office takes its share. You transfer $5,500 from your National Australia Bank savings account to a private seller standing in a suburban Woolworths car park to buy the Corolla outright. It rattles nervously at 90 kilometers an hour on the Monash freeway. Your brother signs a restrictive novated lease for the Audi. The paperwork shows a monthly deduction of $1,200 coming directly out of his pre-tax salary. He tells you proudly that it lowers his taxable income, saving him from the looming HEX repayment cliff. You nod slowly. You set up a quiet automatic transfer of $800 every month into a Vanguard index fund. The Corolla smells faintly of damp carpet. You buy a $3 vanilla air freshener from Super Cheap Auto and hang it from the mirror. Your brother drives you to lunch in the Audi. The cabin is completely silent. He connects his phone wirelessly to the digital dashboard. You watch his hands resting on the leather steering wheel. You look out the tinted window at the passing traffic, the quiet hum of the German engine reminding you exactly of where you currently sit in the family hierarchy. Year 3, the invisible shift. You sit in the mechanic's cramped waiting room, staring at a faded calendar, smelling burnt engine oil. The mechanic calls your name. The Corolla desperately needs a new alternator and front brake pads. The quote is $950. You wince. You transfer the money directly from your emergency fund. Your brother laughs loudly at Sunday lunch when you mention the bill. His Audi is fully maintained under the complex lease agreement. He drops it casually at the massive dealership in Artarmon, drinks a complimentary espresso, and drives a pristine loan car to his office. He does not see the balloon payment waiting silently for him at the end of year 5. He does not see the aggressive depreciation compounding negatively against his overall net worth every time he turns the ignition. Your HEX debt suddenly indexes at a brutal 7.1%, adding $3,000 to your total balance overnight. The system applies the financial pressure exactly where you cannot fight it, skimming your take-home pay before you even see it. But your Vanguard account has steadily grown. You log in via the app while sitting quietly on the train to Central Station. The balance sits exactly at $32,400. You are officially earning dividends now. The corporate companies paying you those dividends are the exact same ones issuing the expensive car loans to your brother. You pay the mechanic without going into debt. You drive the rattling Corolla home. Year 5, the balloon payment. Your brother's novated lease term ends. The residual balloon payment required to keep the car is $35,000. He does not have $35,000 in liquid cash. His luxurious lifestyle has rapidly expanded to completely consume his $95,000 salary. Rent on his cramped one-bedroom apartment in Surrey Hills is an eye-watering $900 a week. He regularly drinks $15 pints of craft beer at the pub. To pay the massive balloon, he rolls the residual debt straight into a brand new novated lease for an upgraded Audi Q7. The new salary deduction is an incredible $1,600 a month. The financial trap springs shut, locking his cash flow into another depreciating asset for a further 5 years. You sit at your laptop on a quiet Tuesday night. Your annual salary has bumped up to $110,000. You log securely into your Australian super account. You click the button to make a voluntary concessional contribution. You push exactly $5,000 straight in, bringing your total up to the concessional contributions cap of $30,000 for the financial year. The 11.5% super guarantee rate from your employer does the heavy lifting, but your extra cash drops your taxable income beautifully. More importantly, it locks that money away, silently compounding until you hit your preservation age of 60. You cannot drive it, and you cannot show it off at a family dinner, but it is undeniably yours. The median house price in Sydney officially passes $1.6 million. It feels impossible, but your index funds now sit at $88,000. You literally own a tiny, profitable slice of the Australian economy. The Corolla needs a new set of basic tires. You buy the mid-range Kumhos for $400. You drive slowly past the massive Audi dealership. The brand new models are lined up behind the spotless glass, shining aggressively under the bright halogens. Year 7, the compound effect. Your brother is finally promoted to a senior director role. He earns $160,000 a year. He celebrates by immediately refinancing his massive car loan and borrowing another $20,000 to fund a summer trip to Europe. He is earning top-tier money, banking corporate bonuses, yet his actual net worth is negative $20,000 when you subtract the vehicle debt and his credit cards. He pays the brutal top marginal tax rate on every single dollar over $190,000, complaining bitterly about the Australian Taxation Office stealing his hard-earned money and restricting his lifestyle. You currently earn $130,000. You still drive the exact same Corolla. The silver paint on the roof is completely gone, leaving bare grey primer exposed to the harsh elements. You park casually at the local Westfield shopping centre, right next to a gleaming white Range Rover. You do not care anymore. The emotional sting is gone. You open your banking app while standing in line for coffee. You officially have a house deposit. You have $180,000 in pure liquid cash, sitting safely in a high-interest savings account, generating exactly $700 a month in pure interest. The capital gains tax 50% discount means your substantial index fund returns are heavily protected if you sell. But you absolutely do not sell. You hold. You understand the brutal math completely now. Your brother is just renting luxury. You are actively buying freedom. You attend a noisy family barbecue. Your brother aggressively complains about the soaring cost of living, the ridiculous price of premium unleaded petrol, the Division 293 tax threshold that might hit him hard, and the absolute impossibility of ever buying property in a capital city. You turn the cheap sausages on the barbecue. You say absolutely nothing. Wealth is what you do not see. You are constantly conditioned to purchase immediate status, to soothe the terrifying anxiety of an uncertain financial future. When the ruthless Australian property market demands a $200,000 cash deposit just to unlock the front door of a crumbling, damp two-bedroom unit in the middle-ring suburbs, buying a heavily financed European SUV becomes a synthetic victory. It brilliantly provides the immediate dopamine hit of perceived success. It gives you a heavy, expensive key fob to toss casually onto a kitchen bench. It signals desperately to your family that you are winning the economic game. The massive financial institutions know this intimately. They aggressively prey on your desperate human desire to be perceived as highly successful by your peers. They kindly offer you a monthly payment plan for emotional validation. You willingly swallow the massive monthly fee because the alternative is standing still and admitting that you are 35 years old, working 50 hours a week, and absolutely no closer to actual financial security than you were at 25. The luxury car is just a heavy metallic blanket perfectly designed to cover up the sheer, waking terror of a zero net worth. You stand quietly in the driveway under the warm orange glow of the street lamp. The loud family Christmas dinner is finally over. You watch your brother walk proudly to his charcoal Audi. He confidently presses the unlock button on the fob. The bright indicators flash twice in the dark. The brilliant LED headlights sweep beautifully across the concrete pavement. He climbs into the driver's seat, the heavy door shutting firmly with a deep sound, exactly like a bank vault locking. He reverses slowly out into the street, the quiet engine humming perfectly, the bright red taillights disappearing quickly down the dark suburban street. You walk slowly over to your 2008 Corolla. The front left tire is still resting deep in the dry summer grass. You slide the plain, faded metal key into the ignition barrel. You wait exactly 3 seconds for the old fuel pump to prime. You turn the key forward. The engine catches, loud and rough. You pull the heavy gear lever down into drive. You steer carefully away from the concrete curb. The person sitting in that exact driver's seat 5 long years ago felt a deep shame at the sight of peeling paint. But you know exactly what the real numbers look like now. You know the exact financial cost of the metallic performance retreating rapidly down the street ahead of you. And you know the exact weight of the freedom sitting quietly in your bank accounts. Your journey is not about endless deprivation. It is about consciously choosing which game you actually want to win. If you want to build the quiet discipline required to walk straight past the flashy dealership and buy back your own future, subscribe to this channel so we can keep building that invisible wealth together. The loudest asset in the driveway is usually the poorest person in the room.